The all-important FOMC meet is underway. Stocks correct on Wall Street ahead of what is expected to be a third straight 75 basis points hike from the Fed to quell persistently high inflation. Yields to jump with the 2-year Treasury yield hitting its highest level in 15 years, while the 10-year yield hits 11-year highs. Asian markets open lower, led by weak cues from Wall Street. The SGX Nifty 2 indicates a lower start for the Indian market. Crude slumps. Brent trades at around $90 a barrel on concerns that a stronger dollar and impending rate hikes could hit demand and weigh on prices. Very small chances of a soft landing, says JP Morgan's chairman and CEO Jamie Dimon, as he hints at the possibility of a hard or mild recession. In a CNBC TV18 exclusive, he also warns of a possible recession in Europe and fickle market conditions, especially in emerging markets. Hi guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are all of the top headlines that we're tracking for you this morning. It is a complete wait and watch ahead of what the Fed is going to announce tonight. The decision will be out at around 11 p.m. tonight, so we're all waiting by for that. But ahead of that, let's quickly take a look at what's happening in the global markets. We did see a negative close on Wall Street, and on the back of that, you have all of the Asian markets which are opening with cuts. What's looking the worst is the Japanese market. The Nikkei index will come up for you, and that one it's currently around 380 points lower, so 1.4% gone on the Nikkei markets. Hang Seng also on your screen seeing similar levels, 260 points lower or 1.4% lower there as well. Taiwan is around 0.6% in the red. And whether you look at Straits, Shanghai, Taiwan, all of them actually seeing cuts between 0.5% and 1% each. So it's definitely quite a negative open for the Asian markets. Remember, this is after the kind of sharp rally that we saw yesterday. So do keep these rates on your radar. The SGX Nifty will also come up for you, and that is indicating a weak start for our own markets. We're currently around 80 points in the red on the SGX Nifty. So that's what's happening across the Asian markets. But let's also talk about the US now. Wall Street ended Tuesday's trading session lower. So the Dow Jones and S&P 500 closed just above 1% in the red, while the Nasdaq Composite ended around 1% lower in the trading session. Now, all eyes are on the Fed decision and Jerome Powell's commentary later tonight. The September CNBC Fed survey shows that on average, respondents believe a 75 basis points hike is imminent, bringing the federal funds rate to 3.1%. Now, respondents also say that the central bank will remain at peak rate for nearly 11 months. CNBC's Steve Leisman is here with a quick wrap-up of all of the highlights from this Fed survey. Steve.
Wall Street increasingly embracing the idea that the Fed is going to hike and hold at a restrictive rate rather than the old idea, which was that it would stop short and then cut quickly. The September CNBC Fed survey finding that 75 basis points is the call for this week. All of our 35 respondents, except for 2 who put it at 100, but mostly saying 75. Then that peak rate, the terminal rate, 4.26 now. And that is 40 basis points higher than the July survey. That peak rate is hit in March of 2023. Then the important question we asked this time, how long will the Fed hold there? 11 months is the number, with some saying as few as 3, some saying as many as 24. The recession risk now 52%, little changed in the next 12 months, by the way, little change from the prior survey. John Riding writes, the Fed has finally realized the seriousness of the inflation problem and has pivoted to messaging a positive real policy rate for an extended period of time. That's the important part there. So there's the trajectory. 240 right now, 238, call it. We reach near 4% by the end of this year, go up to that peak rate in March. And then you can see that there is some cuts built in. That's the result of some thinking the Fed turns tail quickly. But the average, again, thinking the Fed stays there and holds, with cuts coming perhaps into 2024. Rates stay high because the 35 respondents think that it takes a long time for the Fed to bring down inflation to its 2% target. We're 8.3 now. We go to 6.8 on the CPI by the end of the year, 3.6 by the end of 2023. It isn't until 2024. Just 60% believe the Fed hits the 2% target. By the way, more than 80% of respondents did not change their inflation forecast over the next 2 years because of the Inflation Reduction Act. Along with the recession risk comes an expected rise in unemployment. Take a look here, what's expected to happen. You're at 3.7 now. Go to 3.8. Not too much damage by the end of this year, but next year, 4.4. It's still an historically low rate, but you often don't see a 1 percentage point increase from the bottom outside of a recession. While these respondents have argued over the past several months that the Fed was way behind the curve in tightening policy, Many also now are concerned about the opposite, that it will go too far or further than it needs to go.
All right, Steve, thanks a lot for bringing us all of the highlights from the Fed survey. But on that note now, here are some opinion on the likely Fed decision, as well as the implications that it could have from former Fed officials as well as market experts. So let's listen into that.
If the Fed surprises the markets and goes 100 basis points, that suggests they're much more worried than we think they are. And I think that would cause a lot of tumult. But I think it's pretty clear that they'll go 75. I don't really see why they would need to move 100 basis points. I don't think they were that surprised that the core inflation numbers were not coming down, because rents are such an important driver of that, and rents are lagging. I think they will start to grow at a lower pace, but not yet.
I think they probably recognize the necessity, and they've said this many times, the necessity of the economy slowing if they're going to get a handle on inflation. And I think the Fed has been, Jay Powell has been steadfast at least since August, about the importance of the Fed regaining its grip on inflation. That's good news. I'm glad to hear that. And other FOMC members have been saying the same thing. I wonder sometimes where that commitment was a year and a half ago, when it should have been in present, but it hasn't been. So I think they're pretty steadfast. They are not concerned about a slowing of the economy at this point. Will they escape a recession? That's hard to tell yet.
I mean, the bottom line is we want to see inflation brought under control. I mean, I think that's what all global markets are focused on. And I think what's also clear is we think in terms of financial conditions, and financial conditions probably need to get tighter to accomplish that goal. This summer, after we already had rate hikes, financial conditions actually loosened in August. I think, Chair Powell's Jackson Hole speech and the CPI print in the U.S. Last week confirmed that we do need tighter financial conditions. So you could say it's a bit of a painful medicine, but it's a necessary one to bring inflation under control. I think all global markets are keying off of U.S. rates at the current moment.
All right, that is an important opinion that we're tracking ahead of the Fed meet today. But with that, let's also bring you the final update from our global market wrap. We had European markets, which also ended Tuesday's trading session lower. So the French CAC index, as well as the German DAX index, closed over 1% lower. And the British FTSE is also going to come up on your screen. That was down around 40 points at the close. Remember, the British FTSE index was opening after a one-day holiday on account of the Queen's funeral, and it saw a cut of around 40 points. In Germany, we saw the producer price inflation hit an all-time high of 45.8% in August. This is on a year-on-year basis. And of course, this was largely driven by the soaring energy prices that we have been talking about. Now, we mentioned time and again that this is a week of heavy central bank action. So we had the Swedish Central Bank, which announced a 100 basis points hike, which takes its main policy rate to 1.75%. And they've also warned, pretty much like every central bank that we've had commentary coming from, that inflation is much too high for comfort. So that's everything that we're tracking as far as the global markets go. But let's now talk about all of the cues that you should be tracking as we get into a fresh new trading session. We have Rima, Mangalam, as well as Vivek to take us through the trade setup and all of the stocks that you should keep on your radar today. Guys, a very good morning to all of you. And Rima, let me come across to you first. It is going to be all about the Fed today.
It's all about the Fed, but not to forget, in the middle of that, Ford issued a very gloomy outlook. It slashed its profit warning, and that's got a lot of the people in the United States also worried about the U.S. corporate profitability, because it's not just Ford yesterday. Earlier, you had FedEx, before that, Walmart, Target. All of them are warning of, the inflation hit, slowing global demand. So that's, of course, added to the worries in the United States. So what we had yesterday is a session where Wall Street ended with cuts of close to about 1%. The U.S. 10-year yield has hit levels of 3.55% ahead of the FOMC outcome. The 2-year yield has hit a 15-year high, almost nudging that 4% mark. The big focus is going to be at 11:30 p.m. India time. That's when we will get the outcome from the Federal Reserve, and whether it's going to be a 75 basis points or a 100 basis points rate hikes, all eyes will be glued at 11:30 p.m. India time. For our own markets, as we've been saying, we've been resilient. So even yesterday, the markets gained for the second consecutive session. The sectoral indices ended with gains of close to about 1%. The Nifty had a gap up opening. It only built on those strength. And yesterday, you had big buying seen by the FIs in the cash market. Nearly 1,200 crores bought by the FIs in cash, while the DIIs bought 132 crore in cash. So both the institutional lending their support to the Indian markets in yesterday's trade. Back to you.
All right, Rima, thanks a lot for laying all of those cues on the table. But let's now also bring in Vivek, who has the entire list of stocks that we should watch out for. Vivek, we're waiting for the Fed meeting, but let's not forget we have a full trading session before that. And there is some important stock-specific action as well post-market close.
Well, absolutely right. There's a whole host of stocks to keep on your radar. First on our list is Triveni Engineering as well as Triveni Turbine. Remember, Triveni Engineering holds almost 21.85% stake in Triveni Turbine, and it's been a stated objective of the company to pair this particular stake in order for them to go ahead and proceed. And what we understand is that, as per our sources, is in today's trading session, there's most likely going to be a block deal. Now, this particular block deal could be in two tranches. The first tranche would be 11.85% stake sale by Triveni Engineering and Triveni Turbine, and this would be to external buyers. We also understand that the remaining 10% of this particular stake held by Triveni Engineering could be bought back by the promoters of Triveni Turbine. We had reached out to both the managements of Triveni Engineering and Triveni Turbine. We are yet to receive a response on this particular query. The other stock on the list is Central Bank of India. Some positive news flow coming in. RBI has removed this particular bank from the PCA restrictions. Also, the other stock on the radar is Yes Bank. Now, this is a confirmation of a CNBC-TV18 news break. The company did not receive any challengers as far as JC Flowers' base bid for the 48,000 crore NPA portfolio, and which actually means that JC Flowers is now the winning bidder. Also, keep an eye out for the entire tractor pack. Now, M&M, Swaraj Engines, as well as Kirloskar Industries, all of them are involved. The stock in focus would be Swaraj Engines. Now, yesterday, in a filing to the exchanges, M&M has said that it's looking to acquire close to 17.41% entire stake held by Kirloskar Industries in Swaraj Engines, and after that, the stake held by Mahindra and Mahindra would increase to 52.13%. Lastly, a very interesting block deal yesterday took place. TFCIL, that is Tourism Finance Corporation, two FPI investors, who held significant stakes. We're talking about India Opportunities Fund, selling the entire 9.03% stake in the company, and also Tamaka Capital from Mauritius sold the entire 2.68% stake in the company. Two clean-out trades. It'll be interesting to see how these stocks perform in today's trading session.
All right, Vivek, we'll wait to see how all of these stocks fared in trading session today. So thanks a lot for taking us through that list. Finally, it's over to Mangalam, who's looking at all of the cues from the futures and options space. Mangalam, it was an over 1% higher close yesterday. So take us through what we should track today.
Well, second day running, we saw the markets close higher yesterday, and it was the second day where the shorts threw in their towel as well, because there was short covering that we saw. Almost 200 points on the Nifty on the way up is what we saw in yesterday's trading session. And if you just take a look at the index futures action by the FIs, they bought almost 1,850 odd crores at about 2,800 longs. But importantly, for the second day running, upwards of 10,000 shorts. This time around 17,500 short contracts have been covered. And as a result of which, the FI longs, which were at 76% sometime in the middle of last week, have now come down all the way to 61%. And conversely, the longs have increased to 39% as well. What also helped the market was that there was a dearth of sellers in the cash market. Both the DIIs as well as the FIs bought in the cash market. Net inflows close to around that 1,400 crore mark. And even if you take a look at the index options, the FIs continue to cover calls. In fact, in the, yesterday's trading session and the session before that, the FIs covered short calls. So that's telling you that shorts are throwing their towels in. Because if you take a look at it, in just the last two trading sessions, they've covered 28,000 short contracts in index futures and 88,000 short calls itself. Put writers were active at close to around 17,800. And that's telling you that 17,700 is an important mark for the market. The Nifty, the SGX Nifty is indicating a start around the 20-day moving average of 17,711. That's the SGX Nifty start. And the 20-day moving average is 17,690 thereabouts. Dips have been bought into. Will this one be bought into or not is something that we'll have to watch out for. And this short covering will sustain if the Nifty stays above yesterday's high as well, because yesterday in the last hour, we did see some profit taking.
All right, Mangalam, Rima, as well as Vivek, thank you very much for joining us and taking us through that entire trade setup as we get into a fresh trading session. With that, it's time for our first short break on the show. But up next, speaking exclusively to CNBC TV18, JP Morgan's chairman and CEO Jamie Dimon warns of a recession and says there is only a small chance of a soft landing as the Fed continues on its rate hike trajectory. Stay tuned, excerpts from that chat when we come back. Welcome back. You're still tuned into Power Breakfast, and let's bring you an exclusive now. There is a very small chance of a soft landing, says JP Morgan's chairman and CEO Jamie Dimon. Speaking to CNBC TV18, he hints at the possibility of a hard or mild recession and warns of fickle market conditions. This is especially with regard to emerging markets. So let's listen in to that chat.
One thing I can project with certainty is volatility in the markets. And because you can't have all this turbulence, this is going to go on for a while. Yet you don't know where rates are going to change. The dollar is very strong. America is still strong. Is it going to be a recession? What's the real effect of QT and getting rid of negative rates? Europe is probably going to recession. That creates huge amounts of volatility. And unfortunately, that kind of volatility, if you look at emerging markets and the strong dollar, you have to go country by country. Markets can get pretty fickle, particularly when you're investing in emerging markets, venture capital, things where small changes in assumptions can change the value of what you think something's worth quite a bit. So they should be braced for flow of funds that they don't particularly like. And the other thing about the dollar is that an economy which is outperforming other people relative to expectations will probably have a stronger currency. And America is still outperforming, I think, what most people kind of expect, and that may go on for a while. So the dollar may not strengthen, but I'm not sure you're going to see it weaken either. A soft landing is probably a very small chance at this point, but mild recession, hard recession, they're all possible. And it's hard for me to give them odds, but they're all kind of possible. And remember, when I say get ready for it, I'm also talking to companies and investors where my real point is we're prepared for it so we can serve our clients. We're going to be serving clients in India regardless of whether it's a hurricane or a mild storm.
All right, very interesting chat, and you can catch excerpts of this conversation all day today only on CNBC TV18. With that, we're going to get into a short break now, but you don't go anywhere because when we come back, we're tracking all of the action from the commodity markets. Stay tuned for that. Welcome back. You're still watching Power Breakfast. And as promised, let's talk about the commodity space now. Manisha Gupta joins us with an update. Manisha, good morning. There seems to be a little bit of a slip across commodities, whether it's crude or metals.
Oh, well, absolutely. With Bank of the U.S. Fed going for a fifth rate hike and a third 75 basis point rate hike, yes, we have seen a pressure across commodities here. The U.S. dollar index is holding at around 110, and that has weighed on gold, which is trading at a 29-month low. Silver prices fell nearly 2% overnight. We have seen the natural gas prices decline. The crude is trading under pressure as well, as the higher interest rates may slow economic growth. Also, the IEA has forecasted a weak crude demand for the fourth quarter. That's weighing onto the prices also. And yes, there is a sell-off across base metal prices. You have steel, which is trading at a 5-week low. Aluminum prices trading at a 17-month low. We've seen copper prices come down to a 3-week low. Zinc is trading at a 2-month low. And well, yes, I could go on. That's exactly how the commodity markets are trading right now. And it doesn't end there because you have Bank of England monetary policy meeting as well. You have Britain, Norway, Switzerland, Japan also holding monetary policy meetings this week. So the market's really kind of tentative, wobbly ahead of all of this.
All right, that is the big cue we're all watching out for. Manisha, thanks a lot for bringing us that update. With that, a quick look at the Asian markets. Most of them still lower. It's only the Straits which has recovered a little bit, and it is back in positive territory. The Dow futures, by the way, have recovered, and they're around 35 points in the green right now. But the SGX Nifty is still in the red, around 70 points lower on the SGX Nifty. Thanks a lot for tuning into Power Breakfast. We have Bazaar Morning Call up next.